We look at what is happening in the markets and the rally that continues to happen, and people are scratching their head and saying, why are stocks continuing to rally? Well, there's so much that goes into that. One of the things is an unbelievable amount of liquidity, $1.9 trillion, and those checks might go out this weekend. So that money will eventually either be saved or spent, but it's going to make its way through the economy. And so how do stocks get affected by that? Well, we have to look at earnings. There's no question right now that the money's going to have to find a home.
Right. What I was surprised in reading the fine print of that bill is that $1.4 trillion of it is going to be released in the first 5 months subsequent to passage, which is much quicker than you normally see from government programs. The other thing that amazed me is we've now spent $6 trillion in fiscal stimulus since the pandemic began, which is 3 times what we spent during the great financial crisis. So a ton of liquidity hitting the market. And by contrast, remember everyone thought how stimulative the Trump tax cuts were. That was $700 billion over 10 years. So this is massive stimulus and shouldn't be underestimated.
No, I agree with that. And by the way, more is coming because the infrastructure bill is already being kicked around, and that's at least what we're hearing is between $2 and $4 trillion. People go, well, where would that money have to go? But it could be anywhere. You think about infrastructure bill. Is it just freeways and highways? Is it safety? But it could be schools. It could be affordable housing. It could be broadband. A lot of places here in Wisconsin and in Illinois don't have the broadband, Danny. And then we got clean energy and clean water as well.
So that's jobs.
It is jobs, but it's debt,
yeah.
right? And so you've got $28 trillion of debt in racking up. You go back to, I think, when President Obama came into office, and I think it was somewhere in the vicinity of $4 trillion, and now we're at $28 trillion, and it's an enormous number. And so both political sides of the aisle continue to spend, and that is an issue as well.
Absolutely, David. I was actually reading a comment that Larry Summers made, and all of this stuff, people are concerned about the dollar, they're concerned about debt, and he basically said the reason we can get away with it is Europe's a museum, Japan is a nursing home, China's a jail, and Bitcoin's an experiment, which I thought was pretty funny.
That is funny. He's a funny guy. So there's no question that we're going to have to watch how this gets done. And by the way, if this infrastructure bill is done with bipartisan support or in reconciliation with the conversation about clean energy and higher taxes, because that's certainly going to get everyone's attention. And, already President Biden said yesterday in his speech he started to talk about fair share of taxations. So that's going to be part of it. And if you start to see higher taxes, will that unnerve the market because of higher capital gains rates, higher income tax rate, higher corporate tax rates, and will there be a repricing in the stock? So it's not a panacea down the road. You're going to have to buy companies that earn money.
Yeah, it certainly seems like this year is going to be a great year for Main Street. Whether it's as good a year for Wall Street remains to be seen, because we certainly have discounted a lot of the fundamental improvement we're seeing, not just in terms of price appreciation from the equity markets, but also in terms of the estimate revisions that analysts have begun to undertake. We saw one of our strategists this week raise his estimate for 2021 and 2022 earnings by 10%. We saw a 10% GDP forecast for Q1 and Q2.
Now, hold on, let me just stop you right there. 10% in those 2 quarters. I think you have to go back to about the beginning of our careers in the early 80s to see anything similar.
That's right. 1983, it would be the strongest back-to-back quarters we've seen in 38 years. So clearly we're operating in kind of uncertain times in a sense, because many people have never managed money during a period of that kind of growth. Very few people managing money today have experienced an inflationary environment. It does require a different toolkit than one that works so well during a disinflationary period, which has really been the last 40 years.
There's no question. Interest rates have gone down, like you said, since 1980. Danny, we've looked at charts all along, and it's unbelievable to see where interest rates have gone in 1980 when they were double digits to where they are to flatline. So interest rates are an important part of the conversation, and we will continue it.